reading is whether or not we're just going to cut it and then re-enter here, or do we just hold it and then dollar cost average right here, putting our average right in this middle area. Number one, we want to make sure we isolate down the different time frames. So you have someone who's an investor who probably looks out for the next few years, maybe even further than that. In an investor's mindset, when you talk about 5-10 years down the line, I think Bitcoin is way higher than it currently is. However, I do view it as needing to go through a cycle known as kind of like the .com bust, right? So you have so many cryptocurrencies out there. There's 18,000+ at this point, more every single day. And it's just too many. It's too much junk in the system. Just like in the late 90s, you had all these .coms, which really didn't do anything, but they got crazy valuations because they had that attachment of .com to them, and investors just paid any price for them. So in terms of the shorter term, now let's talk about swing trading. Swing trading for me can be a hold of a couple days to a few weeks. What I've noticed on Bitcoin is that we are trading within a range here. There's this top line here where you can see perfectly matches these highs. And then you have this bottom white line where you hit it here and hit it here, right? And this line is perfectly parallel. The two white lines are exactly parallel. And so what you've been doing is you've been staying in this range in the near term. Now you have this one yellow line which kind of connects these lows, and I've been trading that line actively as well as this upper line. So when we were up here, I was going short on Bitcoin. A lot of people out there were talking about, oh my goodness, Bitcoin's going to break out. The charts, I literally shut my brain off of emotion. When people are going nuts and are hyping it, I say, well, what does the chart tell me? Really, it's all about the chart. So up here, it was a short. When we came right into this low pivot here, I did buy, and I'm currently still long because we are still holding this line. Short-term target is between 42 and 43,000. So that's a very short-term trade. I may be out of that over the next couple days if we achieve 42 to 43,000. Now, Steve, one of the things I do want to point out, now you might hear me saying, oh, I'm long, but at the same time, that's a very short-term trade. I do want to send a warning sign in the near term or over the next few months, because this bigger pattern is what's known in technical analysis as a bear flag. So you have this big drop from 69,000 down to 33,000, and then basically this choppy sideways consolidation is known in the technical analysis world as bearish consolidation. And the key to remember here is that if you looked at 1,000 of these charts, you would see a majority, probably in the 70 to 80% range, a majority of them break to the downside. All right, so again, we're just looking, technical analysis is basically probabilities, right? It's a way for you to become the casino house versus the gambler, right? So if you go into a casino, and Steve, I don't know if you gamble ever, but you go in, maybe once in a while you walk away with more money than you went in with. But in general, if 1,000 people go into that casino, the casino's making money. And that's what you want to be as a trader. You want to be the person that generally always is making money 8 out of 10 times, 7 out of 10 times. So at least in terms of the overall midterm view, you have to think Bitcoin has further downside here, even with my short-term quick trade to the long side. I know you've traded since you were very, very young, Steve, so you've kind of been through this. And what I learned early in my career was that when you get emotionally attached, you generally get swung by emotion. And emotion, when it swings you, can make you do the wrong thing at the wrong time. And so early on, I always would fall victim to this. I would be in love with a stock, and people today are in love with Tesla, Bitcoin. There's all these kind of grouped stocks and cryptos that people are just in love with. So I think the best thing to understand is remember that it's a vehicle, and that's it. It's an entity for you to make money for you and your family. And if you remember that, then you think much clearer about it. You don't want to fall in love with anything. And I always say this kind of revolves more around Tesla because of Elon Musk, but people are just so into him, and he's a genius. But at the same time, when people are ready to give their firstborn to Tesla to invest in it, remember that when the board of directors is sitting around the table with Elon Musk, they're not saying, that John Smith, we're going to make sure we do everything right for him because he really believes in us. They're going to do what's right for the company and what's right for them. So in turn, you need to do what's right for you and your company, which is your family. Remember over here when last May and June, we were kind of trending lower. And then we had this big breakup. Well, take a look at this. If we draw a line here and we draw it down here, you basically have a channel that was downsloping. And in this situation, it's the opposite, right? So this one was downsloping and it broke to the upside. This one's upsloping, and in general, these break to the downside. So it's almost like it teases the small investor's mind, where they think, oh, higher lows, higher highs, this is bullish, and then the chart is like, nope, not so fast. We're going to take your money. Over here, people kept on seeing lower lows and lower highs, and they got very bearish. So what does the market do? It goes the opposite way in the scheme of things here. I'm going to trade the ranges. Do I know enough? Am I not going to get swayed by emotion? If you're going to get swayed by emotion, just stay away. In this pattern is bearish, which ultimately should yield further downside. So I would say you stay with what you have now. Some people ask me and they say, well, I'm still holding up some Bitcoin. Should I just sell it at this point and then look to get in at 20,000 or 25 or 30,000? And what I would say is you don't necessarily need to sell at this point because we're already so significantly off the high, but make a game plan and say to yourself, okay, every 5,000 down on Bitcoin, I'm going to dollar cost average and build, right? And this way you're not all going in here or adding to your position at these higher levels. But if you add as you fall, you'll bring your overall average down. And I never want someone to, like, if they really believe in it, I don't want them to sell, because if I say it's going to 20, let's say, and it goes to 21 and then it rips to 100, I'm going to take the blame on that and they're going to be upset. So hold what you believe in, but then look to dollar cost average. Dollar cost averaging has been one of the best things I've ever started to do in my career. It has helped me get better averages, and I would recommend doing that. What I do is I do a risk analysis, and I say to myself, okay, what's the macro pattern? Macro means big. So the big pattern is bearish, right? So in general, it's a matter of time before we go lower. So you don't want to say, okay, well, right at this level, I'm going to put 100% of my portfolio in Bitcoin, hoping for a $2,000 bounce when it could drop $5,000 or $10,000 on me. So literally what I did, and this is in my service, is we bought 4% of our portfolio in Bitcoin right here. We're about up $1,500 per coin at this point, and that's all I did. There's no reason why you have to try to make $1 million off $20,000 overnight. It's slow and steady wins the race. I think that's one of the biggest issues that newer investors have, is that they're so focused on becoming really wealthy so fast that they make mistakes and then they end up paying the price for it. And I always say the best example of this to do is take a calculator and punch in $20,000 and then compound 20% per year of that money. So 20%, then 20%. And what you'll notice is in like 10 years, you have like over $500,000 off of that 20,000. Now take it from the other perspective of being a cowboy and say, okay, $20,000, I'm going to make 100% this year, but then I'm going to lose 50% the next year, because being a cowboy, you're going to have your big losses. And what you'll notice is after 10 years, that's still $20,000. If we zoom in a little bit and let's talk about that, is that basically this is your next big trend line right down here. So when you're looking in terms of risk reward, you have to say to yourself, okay, well, if this trend line breaks and we break down, how much can I lose? And the answer is about, this is right around 30, just under 37,000, or right around 37. So from my entry, which is just underneath 40,000, it would have been about a $3,000 per coin loss. So that was number one, is kind of figuring that out. And then the next thing I did was I decided to myself, I said, okay, I only have 4%. You have to think when you're entering a trade, if something that I don't think is going to happen happens, how do I react? How am I going to trade that around that? So for me, what I told our members is that if it breaks below and it looks like it's gaining momentum, we're going to take a small stop out, somewhere in this vicinity. But the other option, because we only have 4%, and this is the beauty of it, if I had 100% of my portfolio here, I couldn't do this. But the other option is just adding another 4% right here and then looking for that bounce. And that's what I talked to them about. And I said, all right, so listen, I'm going to decide this based on the charts that I'm reading, is whether or not we're just going to cut it and then re-enter here, or do we just hold it and then dollar cost average right here, putting our average right in this middle area? And again, for me, I didn't have to make that decision, mainly because we never confirmed a break of this trend line. But that was something that I was contemplating doing. And the beauty of again, a small position is that you can buy at the next support, then your average is here. And when you get a big bounce, which you should get, considering we have only 1-2 hits here, you could actually get a bounce all the way back to this yellow trend line and then end up making money even if you had to dollar cost average. And again, that's so important. But I do want to just point out that if, let's say, we did buy it down there and dollar cost average, if it did get into this lower range, that's where you have to cut the trade. At that point, you can't risk it because there's nothing below this area. Once you break out of this channel here, you're in dead man's zone, and you could fall $5,000, $6,000, $7,000, $8,000, $9,000 very quickly. So let's say we do, I'm just going to draw on the chart so we can do some annotation here. But so let's say you have a move up in Bitcoin or any asset, and then you start to make that bull flag, which can be, now just a little tidbit, and I'm sure you teach this kind of stuff, but it's awesome, is that technically a bull flag is a right angle. Right? So there's a 90-degree angle here, but in reality, in charts, it's very rare that you get a perfect right angle. So what I always like to tell investors is that anything up to 45 degrees inside of this area here, that is valid in terms of a bullish consolidation pattern. Anything below, I'd be very careful on because it's usually a reversal signal. But let's just say we get this type of consolidation. What you're going to look for is a break of this upper line. And once you get above on that bull flag, that's where you would start to buy and accumulate them more. Now, just to be clear, I'm not one to go from 4% to 100%. I always think on the defensive side. When I was a beginning trader, probably you too, when we went in, we always assumed we were going to win. So we always, well, why wouldn't you put your full account in a trade if you think you're going to win, right? If you're like, oh, I'm going to win, well, sure, let's make as much. In reality, when you get burned enough, like I've been burned in my early career, you start to say, listen, a breakout can look great and it still can fail. Right. So instead, if I had 4% in this bull flag and it broke out, I could see myself going to 10%, but probably that's it. And that's okay, because as you kind of accumulate wealth, you're protection of your downside is the most important thing. All right. How much you make over the life of your career, it's going to compound, it's going to grow. If you have a major loss that wipes out 50% of your portfolio, coming back from that is insanely hard. So again, yes, you with a bullish pattern, you can up it, but I don't recommend going all in ever, to be honest. So one of the things that bothers me about the crypto chart is that this pattern is identical to Amazon's, and we all know Amazon, I'm sure we use Amazon. It's the same chart pattern that Amazon had in the 2000 period before the .com collapse. And look at this M pattern. What I want to do now is quickly go back and show you guys what Amazon looked like back in 2000. So we're going to flip over to the weekly so I can get back there real quick. And we're going to go all the way back. And here's your Amazon chart in 2000, basically 99 to 2000. You see that same sort of M top pattern. So my fear here is that Bitcoin is telling you the pattern formation, and patterns in history are amazing to predict the future, is that you may be coming into this kind of washout phase where you have to wash out a lot of the kind of the crap coins, and you kind of, the best will survive. Now, Amazon was the best, right? It was one of the best. Google, you talk about some of these other ones. And what I love to show people is that, yes, you may get a washout. And by the way, Amazon went from $112 down to $6. So if you map that out to Bitcoin, I mean, this is a worst case scenario, but Bitcoin could be headed down sub 10,000 in that scenario. Now, my target right now is 20,000 or just a little bit less, but just be aware that if it does repeat this kind of formation, then you have a lot of fear and downside to go before you wash out. But the beautiful thing about this is that if we go back, so now this is Amazon in 99, 2000, and I want to zoom out and I want to show you what it looks like if you go back, if you go to today. All right, here it is. So this is the bull case long term of why, if you're just going by charts, here is your M top pattern on Amazon back when it collapsed. Now think about if the M top, if this was a Bitcoin 20 years ago, or now, but in 20 years, where is Bitcoin trading at 3,600, $6 to 3,600? I would say my guess is we'll hit 20K, which is the 2017 high. I understand that has never happened in Bitcoin's history, but at the same time, every bear market, Bitcoin corrects 80 to 85%. So it's going to be interesting because one of those two will be wrong, right? You're either going to have a bear market where you don't go 80, 85%, or you are, and then you're going to take out the 2017 high. So in general, I'm going to start accumulating for the long term when we get around 20 to below 20. And the way I do it is I don't go all in, just like we discussed. I'll probably put 5% of my account, my longer term crypto account in Bitcoin when it gets below or right around 20. And then probably what I'll do is I'll be very regimented. I'll be very robotic. And every maybe 3,000 or 4,000 down, I'll just do another 5%. 5%, and then slowly accumulate. So if it goes to 5,000, that's fine. I'm just dollar cost averaging at that point, and I'll build that longer term position. Try to minimize emotion. Emotion is what's going to get you in trouble. It makes you do the wrong thing at the wrong time. Put that away and then think logically. Is this still getting adopted? Are you still seeing more and more adoption in the Bitcoin and the crypto space? If you are, then continue to, or start to load up or start to buy. And the best thing to do is, you don't have to take, if you have $100,000 to invest, you don't have to put 100,000 right in at 4,000 or 6,000 or 8. Start small. There's nothing wrong with dipping your toe in the water. In fact, that's what I do these days, is I'll dip a toe in the water at a level. If it breaks the level and I still think it's worth it, I'll put another toe in the water, and you'll just accumulate. And that puts you in a great position. And the last thing I would say too is that there's nothing wrong with taking profits on the way up too, right? So if, let's say you accumulate $100,000 of Bitcoin in the sub 10,000 or sub 20,000 range, if it's up 20 or 30%, pocket a little bit of that, because you don't know, maybe it'll come back down, maybe it's going to go lower, but pocket a little bit, have some assets in your pocket, and then you can always redeploy them in the right scenario. And if Bitcoin keeps going up, you're going to make money with the remaining position as well. So number one, what I would need to see is that, just in the near term, this channel would have to get broken to the upside. So as long as we maintain this channel, this is what we would call the bear channel. If you were to start trading above this channel like here, I would start to say, okay, is the bear thesis kind of dead? And I think that's a great point, is that as a trader, you can't be all in on one angle. You always have to be ready to maneuver, because things can change on a dime. And maybe the chart right now is showing me bearish, but if it starts trading up here, then we could start to say, okay, now it's outside of that, maybe it's bullish.